Hello and welcome to Wall Street Vision. On this show, we explore the thinking of the best investors and we examine lessons from the stock market. I'm your host, Vlad Dolgochev. This show is for informational purposes only and is not investment advice. Check out the show notes for the full disclaimer. Hello, Vision Nation. I hope you had a nice weekend. In this week's episode, we're going to cover the story of how George Soros made over $1 billion by breaking the Bank of England. I'm talking about the famous day people call Black Wednesday. You'll often hear me say that making money by trading currencies is really hard, and I truly believe that. So how did the Soros guy make over $1 billion by trading currencies? In this episode, we'll cover how he did it. We'll also discuss if something like this could happen again, and I'll go over why I think investing in currencies is one of the hardest ways to make money. Before we get into the story, here's a quick overview of George Soros. He's quite a fascinating person. The way Soros got into investing is pretty interesting. He was selling trinkets in a souvenir shop by the seaside, and he realized that's not what he was cut out to do. So he wrote a letter to every managing director at every investment bank in London. 2 of them replied to his letter, and that's how he got his job in investment banking. He later went on to open up his own hedge fund and became a big name in investing. Here's a few other rapid-fire facts about Soros. He got a PhD. People really don't like him. Just read some of the comments online. This guy gets tons of hate. There was even an assassination attempt on him where someone mailed him a pipe bomb. That's nice. Also, he's married to a woman who's 40 years younger than him. Okay, that sounds pretty bad, right? But hear me out. It's not as bad as it sounds. Soros is 90 years old. What's that formula again? You know, the formula to figure out the youngest age you can date someone without it being creepy? So take his age, divide by 2, and add 7. So using that formula, he's in the clear. Now that we have that covered, let's get into the story of how he broke the Bank of England. In the late 70s, European countries had an agreement to keep their currencies trading within certain ranges. This was called the Exchange Rate Mechanism, or ERM agreement. Remember, this happened before the euro existed. Once a country became part of the currency agreement, it had to keep its exchange rates within specific ranges. The reason they did this was because they wanted European countries to work together and avoid situations that would lead to something like a World War I or a World War II. I'm going to get into some economic stuff here because it's going to help you understand the story better, so please bear with me while I take you through a bit of the background info that's important. The story is quite juicy, so it's going to be worth it. With this ERM agreement, if you had the British pound increasing in value compared to the German mark, the British central bank would have to start selling pounds. The central bank would do that to keep the currencies within that range that the agreement outlined. One simple thing to keep in mind throughout the story is the more currency is floating around in the market, the cheaper that currency gets. So if a central bank wants to devalue its currency, it would sell lots of it into the market. If a central bank wanted to increase the value of its currency, it would buy the currency in the open market. I'm not going to go into too much detail, but back in the day and today, each country has to manage its own interest rates, inflation, and economic growth. And doing that is really hard if the country also needs to worry about maintaining specific exchange rates with other currencies. It's like playing whack-a-mole when you have all those variables that the central bank needs to take care of. You get one of the variables under control only to find out that another one is totally out of whack. So if one country has higher inflation or higher interest rates than another country, that would put a big strain on the currency exchange rates, which means there would be the strain on that ERM currency agreement as well. When differences in interest rates or inflation between the countries happened, central banks had to go into the market and support the currency that was getting weaker. So this is what happened in 1992. Germany's economy was doing very well after the fall of the Berlin Wall. Britain's economy was in a recession. When one country is in a recession and another country is going through a big economic boom, The policies that the central banks use have to be different. You can't have the German central bank and the British central bank using the same types of strategies while their countries are going through totally different situations. It just doesn't work. And all of this meant that there was going to be a lot of pressure on the ERM currency agreement. Soros had his hedge fund at the time and he wanted to make money. He figured that after the Berlin Wall came down and Germany was reunited, it was only a matter of time before the currency agreement got into trouble. This became more clear when he had some economies in a recession and Germany was firing on all cylinders. In '92, you had the situation where the British pound was being overvalued relative to the German marks. The British economy was in a recession. Usually when that happens, the country will lower interest rates in order to stimulate their economy. But since Britain had to maintain this artificial currency exchange rate, it held its interest rates high, and holding high interest rates was hurting the economy. You might be thinking, what's the relationship between interest rates and currency exchange rates? That's a great question. A really simple way to think about it is if a country has high interest rates and people think that the government is trustworthy, there is high demand for their currency, which keeps the currency strong. The bad thing about high interest rates is that they slow down economies. That's the situation Britain found itself in. Britain wanted to lower their interest rates, but that would devalue their currency. And there was the currency agreement that they didn't want to go against. Soros was looking at this whole situation licking his chops. If he got this right and figured out the weaknesses of central banks, he'd make an insane amount of money. Soros figured that the Bank of England would not be able to support their currency. If they raised interest rates, they would slow down their economy. So they couldn't really do that. So their last resort was to use their foreign currency reserves to buy British pounds in the open market to strengthen the British pound. Now, banks don't have unlimited foreign currency reserves. So you can only use the strategy for so long before it stops working. Soros looked at the foreign currency reserves of the Bank of England and figured that they would not be able to artificially keep pumping up their currency for a long time. Soros thought all of this through, and this is the thesis that he came up with. The agreement that kept the currencies in an artificial range would break down, which meant that Britain would have to exit the currency agreement, and once that happened, Britain would lower their interest rates to stimulate their economy. When Britain would lower their interest rates, that would cause their currency to lose value. This bet for Soros is known as when he broke the Bank of England. Essentially, he bet against the British pound and he bet on the German mark. So he was thinking that the British pound would devalue, and he thought that the German mark would either keep its value or increase in value. I want to mention that he also made several side bets to diversify his risk. Part of his strategy involved other currencies, stocks, and bonds, but the media headlines just simplified this into one big bet against the Bank of England. I think the reason he diversified his bets is that individually any one of those could fail. But he was hoping that if even a few of the strategies worked out, he'd still make lots of money. It was a way to spread out his risk a little bit, kind of like when a portfolio manager has 10 stocks in their portfolio instead of owning just one. If one stock gets crushed, you still have 9 other stocks to make up for it. Back to Black Wednesday, here's how it went down. Britain had an inflation rate that was 3 times higher than Germany's. The Bank of England already had been purchasing pounds using their foreign currency reserves, and they would not be able to do that for much longer. In August 1992, Soros started to borrow British pounds. Immediately after borrowing the British pounds, he would sell them in the open market and buy German marks. His idea was that once the British pound got devalued, he would be able to buy British pounds at a cheaper price, repay the amount he borrowed, and make a nice profit. As a simple example, let's say he borrowed 1,000 pounds and sold them to get 1,000 German marks. I'm using a 1-to-1 ratio for simplicity. Soros would then wait until the British pound got devalued. Let's say after the British pound got devalued, the new exchange rate went to £1 and 20 pence or 20 cents for each German mark. After the pound got devalued, Soros would then go and exchange his 1,000 German marks, but now he'd get £1,200 in return. Then he'd pay off his loan and any interest and keep the profits and laugh all the way to the bank. On September 16, 1992, Soros heard an interview with the president of the German central bank. In this interview, the president said, "We don't rule out that some currencies might come under pressure." That's my best version of a German accent. It wasn't a groundbreaking statement, but it was a big signal to Soros. That same night, Soros called up anyone he could. He was calling banks, other hedge funds, investment managers, pretty much anyone he knew was asking to borrow British pounds. By the end of the night, Soros borrowed something like £10 billion and sold that whole sum on the open market. Wow, that was a big move. Before we dive into what happened next, I'll quickly mention that if you're enjoying the podcast, please give us a rating and hit the subscribe button. And if you know someone who would find this content valuable, please share this episode with them. My goal for the podcast is to help people learn the lessons from the best investors and to help people understand the stock market better. I think that's important today as there's a lot of information out there that can lead people on the wrong path, and I would love for more people to benefit from this type of content. So Soros sold a massive amount of British pounds in the open market. This huge wave of British pounds hitting the market meant that the British currency started to get weaker. By the morning, the Bank of England kept buying billions of pounds to support their currency. That wasn't really working, so they pulled out all the stops and went to raise the interest rates as a secondary strategy. By the end of that day, Britain had purchased something like £27 billion and increased their interest rate to 15% from 10%, which is absolutely insane. By that point, Soros flooded the market with all the billions and billions of British pounds that he had borrowed, and there were lots of other hedge funds and investment firms that jumped in on this trade as well, essentially overwhelming the market. By the end of the day, Britain was forced to leave the currency agreement. In the next few days, the British pound fell by something like 10%. Soros bought back the British pounds that were now dirt cheap and paid off his loans and any interest that he owed. After all was said and done, he pocketed around $1 billion from this. Soros was the face of the crisis, even though lots of other hedge funds and traders joined in on the strategy once they saw it was going to pay off. Now, the bright side of this whole mess was that when everything was said and done, the Bank of England was now finally able to control its own currency again. So they cut their interest rates, which led to a great economic growth in Britain in the years to come. So this Black Wednesday acted as a sort of rock bottom from where the British economy did really well for many years afterwards. It's kind of like the stories you hear on those TV shows where the struggling family member has to hit their rock bottom before they get better. Alright, so what are some takeaways from this story? Would this be possible today? I would say this is highly unlikely today. Central banks have massive balance sheets. Maybe with a country that has a small balance sheet, something like this could happen. But many central banks of the bigger countries are like mega whales with tons of assets on their balance sheets. If the Bank of England had bigger foreign currency reserves back in 1992, they would have probably been able to support their currency and survive the crisis without leaving the currency agreement. Soros was able to make an insane amount of money by betting on a currency. Is that something that could be replicated? When you listen to Warren Buffett, he talks about how hard it is to predict big macroeconomic events or interest rates movements. It's pretty much impossible to do consistently. I think the reason the Soros trade worked is because of the unique situation of the Bank of England at the time. The Bank of England had their back to the wall with high inflation, high interest rates, a recession, and they had to stick to that currency agreement. Something had to give, and Soros made a bet that exiting the agreement would be their best option, and he was right. So I think currency trading is hard today because these types of situations don't come up all the time. Macroeconomic events are hard to predict and forecast. If you look at economic predictions, so many of them turn out to be wrong. So Soros was successful because of a really unique situation that is super rare. Can something like this happen again? Sure, it can happen, but for it to make sense from an investment perspective, you'd need a bunch of variables to line up like they did in 1992, which is highly unlikely. Another takeaway is that having diversification is important. Soros is known as the guy that broke the Bank of England, but he made many different bets on various currencies, bonds, and stocks. If a few of those didn't work out, then he could still make money from the others. So even when he had a situation that was a sure thing in his mind, he still diversified his bets. I also want to mention that leverage can make people really rich when it goes well. He used a lot of leverage in this trade. I think he borrowed something like $20 for every $1 that he had. It's amazing when leverage works to the investor's advantage because it makes them boatloads of cash. But remember that leverage amplifies gains, but it also amplifies losses. If some of Soros' bets didn't pay off, his fund would have probably gone bankrupt. By the way, you can check out episode number 10 on long-term capital management and their story. There, you had a situation with lots of leverage where it did not pay off for the investors. There's a reason that Warren Buffett stays away from leverage. Leverage brings an asymmetric risk situation where you can get wiped out. And in investing and in life, it's important to be able to live another day, which you can't do if you're bankrupt. Alright, Vision Nation, that wraps it up for this week's episode. If you've enjoyed it, please hit the subscribe button, leave a review, and if you know someone who's interested in investing, please share this episode with them. Thank you, and I hope you have a great day. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. I may maintain positions in the securities discussed on this podcast.